Thanks so much for joining Cherry Bekaert's 2022 Tax Credits and Incentives virtual conference. And if you're just tuning in, this is the first of the modules that you're joining. My name is Marty Kehrman. I lead Cherry Bekaert's Tax Credits and Incentives Advisory Group. And it is great to see a lot of people, though, that signed up before, continuing on into this session. We have a variety of presentations today. This is number 3. We're offering up to 1 hour of CPE per session. And we just wrapped up the session on legislative updates impacting credits and incentives. And again, this is on cost segregation studies and energy credits. But here's some just items of note before we begin the business keeping. To receive CPE credit, you must answer at least 3 polling questions and attend for the full 50 minutes. CPE certificates will be issued via email within 10 days. If you have not received yours after 10 days, please email at cbhlearning@cbh.com. A recorded version of the webinar will be available in approximately 1 week and will be sent via email and posted to our website as well. If you have any questions during the webinar, please type them into the Q&A window located in your control panel. And just note, a short survey will be posted at the conclusion of the webinar. We value your feedback and ask that you take part if you have time. And with that, I just want to introduce our panel of speakers: Ron Wainwright, Mitch Cutler, Victor Jones, Milton Robinson. They're going to get a little time to introduce themselves. And they're going to share some of their experiences conducting cost seg studies and investing in energy savings projects. But honestly, my partner and friend, the leader of this particular conference will be Ron Wainwright. And I will turn it over to Ron right now for an overview. Ron, take it away.
Thank you, Marty. And I also want to thank our panelists. And I'm going to make about 10 minutes of comments. And then we're going to get into a just very open, interactive discussion with 3 different groups that we're fortunate enough to serve, as you saw on the slide. So wanted to lay a little bit of background for those of you who may or may not be familiar, and hopefully you are. So, what is cost segregation? It is a term that is thrown around a lot, that often, in my assessment as a practitioner, can be misunderstood in regards to, well, what is this process? So ultimately, from a tax law perspective, it is about segregating portions, predominantly between real and personal property, of a building purchase or a new construction or an expansion. Ultimately, from a tax law perspective, we are looking to correctly identify, quote, that segregation of real or personal property into a shorter life. As we know or may know, the tax law underneath what's referred to as MAKERS from 1986 allows us to use the modified accelerated recovery cost system to depreciate or expense for tax purposes the asset that we've purchased or constructed or expanded or being improved. And so then it also has implications around the tax liability of the entity. Often this is utilized as a part of a return on investment analysis, as the company may be looking to acquire an asset, expand an asset, et cetera. And so just a general overview of MAKERS. Remember that it is a statutory analysis. There's a volume of regulations that tell us what our class lives, as they refer to. But when you think about a commercial building or a non-residential building, it's 39-year straight line. And then it's 27.5-year straight line if it's a residential, such as an apartment complex, any type of a multi-residential unit, townhouses. And then we get into 15-year and 5 and 7-year property around double declining balance when we talk about land improvements, or qualified improvement property, and then we get into equipment, furniture, and fixtures. And why do you want to structurally analyze it? Is because from an asset class for tax purposes, we know that if we can get a correct asset class to 15 years or less, there's an opportunity to expense that immediately, whether it's underneath the qualified improvement property rules, which deal with obviously interior of a property that you might be enhancing or leasing, specifically not related to an elevator or an escalator. And it also applies to non-residential rail property placed in service beginning after December 31 of 2017. And then we also know there's section 179 and section 168K in the statute. 168K is simply the bonus depreciation, where if it's new or used, I can and bonus it, but it has to have a class life under 15 years. Same context, if you will, when we're really evaluating 5, 7, 10, and 15-year property. So we talked about 168K from the bonus depreciation or the immediate expense piece from that standpoint. So when we think about an example, and we're going to get into some discussions with our panelists, but here's an example of where a large real estate fund acquired 33 different pieces of property, medical real estate, investment firm, investing in this specific case, and this is just one of their acquisitions, purchase price about $330 million. And so what did that mean? So when we completed our cost segregation analysis, our fixed asset review analysis, our QIP analysis, our bonus depreciation analysis, we ultimately identified using a structural approach between real and personal property, a first-year tax deduction of $118 million. As you can see, that ultimately generated a tax benefit for them of $47 million of tax savings. And so when you think about their analysis of spending $330 million, but yet being able to immediately have the federal government and, depending on the state government subsidize that $330 million by almost $48 million, pretty significant. We do everything on time and materials. And so, we don't charge like other firms do, some type of a percentage of the depreciation expense or the tax savings. So we're very much what is called a time and materials. That brings us to our first polling question. So when you think about the cost segregation process of separating a building into categories, what are your thoughts when we're segregating? What are we looking at? All right, we've got very solid participation, and I'm pleased to tell you that 89% of you got that answer right. So hopefully you were listening. And so yes, we're looking at quote structural, real property, personal property. Now this is a new update, and this came out June of 2022. So as we may know, the service releases what are referred to as audit technique guidelines. So in the event of an examination, whether it be for R&D as an example, or whether it be for a uniform capitalization question, or whether it be for cost segregation. Now, interestingly enough, the last time the audit technique guideline was released by the IRS for cost segregation was 18 years ago. So this has been a long time in the making. But ultimately what it did, it focused on cost segregation and the implications of completing a cost segregation and wanting to ensure, very similar to the other presentations in our other panels today, that taxpayers understood the statute, they were engaging a very high quality firm, and that it was being done correctly. So there is a lot of implications when you think about a cost segregation study around, well, we'll talk about 179 Cap D deductions or energy efficiency deductions or bonus depreciation and qualified improvement. So as you see, there's been a lot of change in tax law in recent years, from 2015 to the Tax Cuts Jobs Act of 2017, and then fast forward to what is referred to as the CARES Act of 2020, and then the Consolidation Appropriation. So a lot of changes in the law, and this is really more of a clarification. I'm pleased to tell you that in our review, we were completing everything in advance. So the audit technique guideline, we believe it was very beneficial to taxpayers. Some did not, but we did. So here is our next question, our polling question number 2. Bonus depreciation is, all right, I'm pleased to report that 84% of you were correct in your answer, is that it allows you to expense, to the extent you are doing a cost segregation study or a fixed asset review analysis, et cetera, the purchase expansion in the first year. And this is very important under 168K. So let's move to energy incentives. So when we think about 179 Cap D, we're only going to be able to talk about two energy incentives today, 179D and 45L. So when you think about 179D of the statute, this came in underneath what was referred to as the Energy Policy Act of 2005. And then it was in and out of the statute, but it has now been made permanent in the statute as of 12/31/21. But basically what it is it's a phantom deduction to the extent that the property or the expansion of the property is either designed or has been constructed in an energy efficient manner. Now, this is predominantly for commercial buildings. And then when you think about, residential of 3 stories or less, we get into, 45L of the statute, if you will. But it's a phantom deduction, but it does reduce your basis. So when I say phantom, it accelerates gross square footage of the property, including common areas, up to $1.80 out of that 39-year property or 27.5-year property where applicable. And again, it's about new construction or buildings that are being improved. And then there are special provisions, as we'll talk to one of our panelists in regards to government buildings specifically. So I wanted to kind of cover a real quick analysis for you. So this is one of our clients, very large architecture and engineering firm that is taking advantage of the governmental side of 179 Cap D. So these are the deductions they received that were transferred from a governmental entity where they were ultimately the architect and engineering firm of record designing the energy efficiency building. And as you can see, over since 2012 through 20, they, and I could have gone back further, but I just did a snapshot of 12 through 20. They've really received $9 million of what were really phantom deductions, because the governmental entities are required to transfer the tax deduction because they're a non-taxable entity. And so they transferred $8.9 million of phantom deductions to the A&E firm, which of course immediately reduced their tax liability in the given years. But you must be designing for some form of a governmental entity. So that brings us to polling 3. So the Section 179 Cap D expense is comprised of the following 3 component deductions. All right, let's wrap this poll up in the spirit of time. And I'm pleased to say again that 81% of you got the answer correct. So what the Energy Efficiency or the Energy Policy Act of 2005 was all about was obviously when you think about a building, the lighting in the buildings, i.e. LED lighting, and the building envelope around insulation, around doors and windows, and roofing, if you will. So we did get a quick question. So when you think about what most people call HVAC, we call it HVAS. So the reason for that is because most commercial buildings have now energy management systems that have been placed in the building depending on the size. So technically that's the HVAS to the question. So now let's move to 45L. This is what's referred to as the multi-residential credit, a significant amount of opportunity here. But this belongs to the developer or the builder or the construction entity, but predominantly the developer. And it provides an incentive of $2,000 of credit, and that is credit dollar for dollar of energy efficient construction of residential homes and apartments. And so when you think about what's happened over the last really 5 to 7 years in our economy around multi-residential apartment complexes and the growth, this has been a significant subsidy or incentive in regards to an energy incentive for real estate developers. Unfortunately, the statute expired, but it is expected to the prior presentation to be reinstated and made permanent. But here's a real quick case study just to show you the magnitude of some of our clients and what they've been able. In 2019 and 20, a 400,000 of credit or immediate reduction for simply building and constructing energy efficient, 177 residential homes in 2019 and 20 and 21. So, something that is often overlooked. This brings us to our polling question 4, because I want to get to our panelists. So the Section 45L credit is available for? All right, pleased to say that the majority in poll number 4 got the answer correct, which is 2,000 per unit for efficient construction. So I'm sorry you don't get it for Tesla, but there's other energy efficient credits for Teslas out there, which you might be familiar with. So now I'm pleased to move to our client panel discussion. All right, so let me allow our 3 client panelists to introduce themselves, and then I'm going to moderate a discussion because I want you to hear from clients of ours and certainly those that have utilized cost segregation and 179 Cap D and what it means to them. And also, hopefully, the differentiation of working with Cherry Bekaert. So I'm going to start with Mitch Cutler. And Mitch, if you'll introduce yourself, give everybody a little bit of background, and then I'll move to Victor and Milton appropriately.
Sure. Hi, Ron. Hi, everybody. I'm Mitch Cutler, the CFO for RK Centers. We're a family-owned commercial real estate business. We own mainly outdoor strip centers throughout South Florida and throughout all of New England.
Victor.
Yeah, I'm a principal and partner at Jenkins Pure Architects in Charlotte, North Carolina, and we're a regional architecture firm. We do federal, county, and state work, and have taken advantage of the 179D program.
Milton.
Yes, hi, Ron and Marty. I'm Milton Robinson. I'm the Group Corporate Controller for OCO Group. We are a luxury condo developer both in Miami and also in New York. Right now, we have 3 very active projects in Miami, which is in the Edgewater and South Brickell and Brickell. We have an office, Class A office tower going on. And we will have a large 6-phase multifamily project in Fort Lauderdale as well.
Well, thank you again to each of you for participating today. It's always good to hear from 1, clients, and 2, taxpayers, and what these benefits, whether it's cost seg or energy, mean to you all as a business operator, and what do you take into consideration from an evaluation perspective. So Milton, if I can, start with you, and then I'll move to Mitch. When you think about cost segregation and the project that you mentioned up in New York for the Amman building, help us understand, your team's evaluation, because you've invested about $1.2 billion in a property in New York, and what did cost segregation and mean to you all in your evaluation?
Well, obviously, it's the question about the cost segregation was that why not? Why would we not take advantage of these tax write-off in the early stages of the project and then have to wait until towards the end of it? In the business sense, it didn't make us any sense to have sort of like a very large accounting team to set up internally and to start segregating or start keeping track of the GMP contracts and do that by ourselves instead of just going into somebody like Cherry Bekaert, who are an expert on this, to just do that work for us and identify the areas that we can accelerate the tax write-off.
Mitch,
Yes.
With respect to your and RK Center's evaluation of purchasing and then obviously operating. I mean, same question. You really kind of talk about your analysis and evaluation on the front end as you all are considering, how do I use tax law to save dollars from the financing side as well as the cost side and the tax liability side?
Sure. The cost segregation is actually the main driving force for us to decide if and when and for how much to buy a property. The first thing we do before we even make an offer is a cost segregation benefit analysis to see what the tax savings are going to be. Obviously, the big thing is the bonus depreciation in the first year. And if that meets our criteria, we go ahead and make the offer.
Milton, kind of going back to you, and then I want to move to obviously Victor on 179 Cap D. So when we did the cost benefit analysis in regards to your property up in New York, we were conservative and ultimately, that accelerated, as about $320 million of an immediate expense. And so, what did that mean to you all as an entity, very similar to Mitch's comment around, we evaluated on the front end because the government assists us, whether it's through bonus or cost segregation or QIP analysis in financing that property, knowing you spent about $1.2 billion.
Yeah, so, and obviously, that was, that the key factor as that, the Mitch mentioned, for us, for the return on the investors on there to bring in additional investors to say, okay, you can come in and you can also get to have advantage on the write-off of your taxes, and this additional $320 million was a key factor on making those decisions to bring in additional investors to close out the project.
Right. Thank you. So let me ask Victor a couple questions around 179 Cap D, and I do always want to thank Victor. I will say Jenkins Peer, to their credit, was rated the #1 A&E firm in the state of North Carolina, and that is not an easy award to win. So I wanted to make sure I gave kudos to you and the firm for that. But when we think about the energy efficiency deduction that's been in the statute, as we mentioned, underneath the Energy Policy Act 2005, what impact has that had for Jenkins Peer from a kind of an A&E firm, but more importantly, from a financial and operational perspective?
Right. So I think we've, since about 2016, I guess, we've done a series of projects, including federal, county, state projects. And, we're not that big of a firm, but we've managed to get deductions of over $1 million, which really helps our bottom line when it comes to taxes. We're an S corp, so it's passed through. So it kind of depends on, what your bracket is and your share of, ownership. But yeah, it's definitely worth it. I kind of looked at return on investment, and the smaller projects. I think the smallest project we've done is probably like 20,000 square feet. There was still like a 200% like return on investment in going after the credits using Cherry Bekaert and Holland. And but on a big project, the return on investment can be a lot more, approaching 7. I mean, it's just, it's just free money. It's not what we went to architecture school for, but once I started to understand the program and what it meant to our bottom line, I realized that it really had to be a priority with all of our projects, because all of our projects, both the federal, county, and state projects, due to the state building code, the international building code, pretty much all of them, especially if it's a new project, you're going to hit the $1.80 per square foot deduction for pretty much any project.
So as an architect, and you bring up a good point that I want to, have the panelists kind of talk about. So from an architectural perspective, as you design the energy efficiency within a building, and of course, as you stated, you have to, obviously exceed whatever the municipality or the state codes are. But I mean, are there hurdles or challenges that you've encountered as you're drawing and designing, a governmental type entity, whether it be a school or a hospital, with respect to qualifying for the energy efficiency deduction?
No, because there's nothing exceptional about the criteria, honestly. So when we're actually designing it, there's no kind of impedance in terms of thinking about the 179D program. We know our government projects are going to hit it. Actually, pretty much the private projects will hit it based on, and that's based, most of the work we do is in North Carolina. So I can't speak for all the states, but in the state of North Carolina, which is the only place where we've received the deductions, it was never really an issue. I guess the only time we didn't get $1.80 a square foot was a renovation project to an old, not very energy efficient building to begin with. And, we weren't doing a full tilt replacement of mechanical system and recladding of the building. And so it was only a partial reduction, but still great return on investment. So.
Yeah, you did bring up a good comment that I wanted to add on, is that when you think about the energy efficiency deduction under 179 Cap D, as you know, it is a sliding scale based on the energy efficiency. So it's not an all or nothing around the 60 cents per square foot. It's a sliding scale from, you could earn 20 cents or 40 cents based on the shell, and then earn a full 60 cents based on the HVAS, as we call it, or in essence, the heating, air conditioning, but ultimately turning into a system. So when you think about, I guess, the A&E industry as a whole, and I want to go back to Milton and obviously Mitch, do you think it's well known, knowing it's been in the statute since 2005, or do you see your competitors not recognizing as you're kind of bidding on a project to design? Is it been a value differentiator, and that you're going to derive tax benefits, and that helps you win more projects?
Well, Ron, it's an interesting question, and I will be perfectly honest. I have not had a conversation with one other architect who goes after these deductions, and it's free money. It's like an administrative process. Cherry Bekaert does most all of the work. We have some administrative work to do. But it's just something we do. But I'll be honest, when I go to AIA this or that, they don't know. Most people are completely clueless and don't know about it, which is kind of mind-boggling.
No, it is, and I think some of that is because it kind of came in and out of the statute, but as we now know, it's permanent. So if I can go back to you, Milton, and you, Mitch, kind of asking a similar, question: how well known do you believe, the cost segregation incentive opportunity is when you are talking to, your either competitors? We already, indicated you're evaluated on the front end, but I mean, do you find yourself having to educate your, associates in your business or the investors on the outside, as you commented, to get them on board to complete either a cost segregation study, and of course in your buildings, Mitch, as well as a Milton, 179 Cap D is also applicable?
Well, I believe it's well known to my colleagues who are CPAs. However, our if you want to call them competitors, I don't know if they're too familiar with the benefits that are there. We've been using Cherry Bekaert for Ron, 6-7 years now, and every year the benefits get better and better. And I just like to add that with interest rates going up, the main benefit from a cost segregation study is the time value of money. With money becoming much more expensive these days, it's as important as it's ever been.
Do you find that you're educating banks in regards to the financing side of thing historically and more present because of
Absolutely, absolutely. Yes.
Milton, same question. I mean, from a OCO group, and you all are a multinational company and, building, assets around the world. I mean, do you find, you mentioned that you're investors. And so are you finding you're having to educate investors as well, more on the financing and the bank side now?
Yeah, absolutely. I think that Mitch made a very good comment about the lending side. We just recently closed a loan with JP Morgan for the New York, that's the takeoff loan. Before, Ron and then Cherry Bekaert, that introduced us to this whole cost segregation, the advantage of that, we have existing building that is under construction and all of that. We have never really taken into consideration some of these, the 179 Cap D, the energy efficient design. In fact, on our latest project that is in Fort Lauderdale on the multifamily, we are taking into the energy efficiency into consideration. That is basically the recommendation from Cherry Bekaert, and it's something. It's sort of like obvious, and then I'm not sure why that we have not taken a lot of more businesses or more investors are not taking advantage of the cost segregation study.
Okay. Somewhat, and I'll be upfront, a question, knowing that, a lot of firms, hopefully, are not really taking advantage of this. So when you work with us, and knowing there are different firms offering cost seg services as well as energy services, can you tell, just the group that is, listening in, I mean, what has been your experience with CB in coordinating and all the multidimensional, I'll say, technical aspects that have to be? Has it been an easy process, an administrative process? Because we're dealing with areas of the statute that are complex, but I'd be welcome to your experience with us as well as just experience with your internal team. So we'll start with you, Mitch, if we can.
Well, the thing I like about CB is it's a one-stop shop for everything. I mean, as far as the process goes, I reach out to you, Ron. You provide me with the expected benefits. You give me a low end, a middle end, a high end, and you're always right on the money when you send those numbers to me. And then I receive a contact from one of your engineers. They set up the appointment. It could not be more smooth.
Well, thank you. And Milton, I know we're at the beginning of a couple large projects, but certainly, we welcome your assessment as well.
Yeah, I mean, obviously, it's as Mitch says, it's a one-stop, solution for us, and it's obvious services that we get from it. I'll give you a perfect example. We are also doing a project in Miami Beach, and that's also a little bit of a joint venture. And then the accounting is not going to be done by, the OCO. It's a part agreement, and I actually highly recommend them that, because they want to set up a very detailed team of, fixed asset registers and, the keeping track of the GMP cost in a line item basis. They said, why bother, because it will be a lot of cost for you. Just go to Cherry Bekaert, just develop your project and manage just a general contractor, one contract to manage, and then give it to them, and they will do that work for you. And it's going to be sort of like a 5% of your overall cost that you will ever have to spend on the labor and the other resources. So yeah, it's been a very, very pleasurable experience in working with Cherry Bekaert, because not only that they are our tax accountant, but they're also doing our audit. So there is a little bit of seamless transition between all of that. So yeah, can say more about that. It's a great to have Cherry on our team.
Well, thank you. Victor, going back to you if I can, and we've had a couple sessions earlier in the day where we talked about, in fact, the prior session was all about legislation and what's likely coming. And certainly, you're fully aware that the Biden administration, has proposed changes is really part of whether it was the Build Back Better or now in the American Competes Act around really increasing the 179 cap D benefit, and Mitch and Milton, you're aware of this as well, and actually increasing it from $1.80 upwards of $3. So, in essence, you would not be limited to 60 cents per square foot. You'd go to $1 per square foot, depending on, the three elements. So what would that mean to you as a business and an A&E firm? And then I'll come back to Victor and excuse me, to Mitch and Milton as well on that. But what would that mean to you guys on a go-forward basis?
I mean, it just helps our bottom, it just helps our bottom line. It helps us be competitive. We don't make money on all projects, and so it just helps with liability. So I mean, I think it'd be a really positive thing. And I guess on your first question, I would like to reiterate what Mitch said. It gives us a lot of confidence that it's one-stop shopping with you guys because you're doing our accounting and the 179D, that you're going to stand behind your work. And also it helps because I'm not explaining to another accountant that, if it's tax time, that, there's this bureaucrat at a federal level who hasn't signed a piece of paper that they will sign. It's just a matter of when that we feel confident, just go ahead and file our taxes,
Well, one thing you commented, and I wanted to highlight it for our audience, is that when you think about, whether it's 179 Cap D and the governmental transfer program and really the infrastructure bill that's, been passed back in November that talks about, really revitalizing the infrastructure, there's going to be a tremendous amount of, quote, governmental building occurring over the next 5 years as the 1.2 trillion rolls out. And so, I would assume that you all are really paying close attention to that 1.2 trillion and whether it's, the design of an airport or a school or some type of governmental structure, using 179 Cap D and the enhancement up to $3 is going to be a significant benefit for you. Is that fair?
That's absolutely fair. Yeah, our targets aren't as big as airports and things like that. We're a lot more in the higher ed world, and kind of maybe smaller government stuff. The federal courthouse is like as big as we would be doing. But yeah, it absolutely factors in. And now that it's permanent, we've kind of got that built into our sites, so to speak.
Right. So let me go back, and I want to be respectful of everyone's time as we begin to get to the bottom of the hour. Kind of a last question, for the group. From the standpoint of just kind of the cost segregation and 179 Cap D and some of the pending legislation. And I think, Mitch, you did an excellent job, as always, in regards to, the increased costs that are occurring, from whether it's financing cost or just, quote, raw material costs and construction and development. Milton is the properties you have going on. So, I mean, I think, is it fair to say that the more benefits that can be derived by some of the enhancements that are coming from a clean energy, as well as some of the things that are also contained in the American Competes Act, the incentives and the credits are a key driver or subsidy when it comes to your analysis on the front end as you make business decisions. So I'd like each of you to kind of, comment on that and what you expect to see over the next 3 years.
Yeah, absolutely. It frees up cash immediately, basically immediately in the first year, the asset's placed in service, and it allows our company to do so many more things with that money, whether buy additional properties, whether improve the properties we have, or even pay distributions to our shareholders. So it's a huge driving force. As far as where it's going in the next few years, I wish I had a crystal ball. We hope it continues. I don't know what happened to our business if it didn't.
Milton, same question to you, and then I'll round it out with Victor.
Yeah, it's the same, exactly, and completely in agreement with Mitch on that. It's at the end of the day, it's all about time value of money and IRR. I mean, we did have a little bit of issue with one of our project in Fort Lauderdale, because the cost came in higher, but it's going to be an apartment multifamily, and then we just basically take it into consideration that the savings that we're going to have and the cash, the free cash that we're going to have because of the cost segregation, even in the cost, the rise of cost, the IRR made sense. So it said, oh, okay, so because what we are paying higher over here, we'll ended up getting that benefit. So which is basically with the cost segregation taken into consideration, we are better than what we have originally expected, even with the rising cost.
And Victor.
Yeah, I'm optimistic that because we're not developers and I think you may have said it, but the way architects are able to participate is because of the entities that they're working with doesn't pay taxes anyway, because it's the government versus the developers that actually do get to take advantage of it. So on our government projects, based on what you said about infrastructure spending and things, and the kind of spending towards government projects, I mean, we're pretty busy. We're really busy, and there's no end in sight right now.
All right. I thank you to each of you, Victor and Mitch and Milton, and I hope the client panel was received very well. I'd like to kind of flip it back to Marty for closing comments, because we're coming up on the bottom of the hour.
Absolutely. First of all, thank you guys very much. This was awesome. I think getting it from the client perspective is very helpful for us to hear, and very helpful for us to communicate to our other clients what we do. So I really appreciate that. You guys taking the time is really, we very much appreciate it. With that said, this concludes our third session. So thank everybody for joining us. Again, if you have any additional questions, please reach out to Ron, really, at any time. I'm also happy to field any questions to Ron as well. We value feedback. Ask you take part in a survey at the end, which is posted in the meeting chat. We have one more today. Our final webinar is Guide to the New Markets Tax Credit that begins in about 20 minutes at 3 o'clock Eastern. We hope to see you there. Again, personally, thank you all very much. We put a lot of work into this and we value your participation. So thank you.
Thank you all. Thanks, Milton. Thanks.
Thanks, Ron. Thanks, Marty.
Take care.
Bye-bye.